but you need some trading experience and to really get in there and understand the nuances of what's going on in the market. So to me, it's, it takes time. It's about finding your personality again in the market, your time frame.
Welcome back everyone to I'm sitting down with Brian Shannon, looking forward to discuss about his trading tips and strategies and things he's doing in the market. He recently published a new book also, which we can talk about. So Brian, welcome to the podcast. Good to connect with you.
Yeah, good to be on here finally. It's taken a little while, but here we are.
Awesome. I appreciate it. Looking forward to talk with you. A lot of stuff we can talk about. You've been trading for, I believe, 30 years now or more. So tell us a bit more about kind of what you're doing these days and what it's like these days trading.
Well, the last 3, 4, 5 months have been just, a bull market again. And it's just so much more enjoyable, profitable, less stressful than, 6 months prior to that, we were in a, choppy range following the decline. So, now we've gotten our bull market back and, it's back to finding the low risk entries and managing risk as always.
I want to go back in time and tell us kind of how you began trading and what was that process in the first place?
Yeah, originally I had done, my first trade, I think it was 13 years ago. I'm 55 today. So that's quite a while. And that was a small trade. My dad was into the market and, I kind of rode his coattails on some things and just, was interested in learning. But I got a very successful trade early on in my life. And that kind of just made me think this is what I want to do. I didn't know any better. So I decided I wanted to be a stockbroker. Little did I realize a stockbroker is a glorified telemarketing position. So, it was great experience to be a salesman for a few years and to learn about the market a little bit with other people's money as a retail stockbroker. But I quit that in 1993 and began full-time trading. And that's what I've done ever since then.
How was it like going from a stockbroker to then trading? Was it difficult or did you have to go through a learning curve?
Well, sure. I was pretty young there, so it was definitely a learning curve. The good news was I did have experience basically with other people's money as a stockbroker. And, when I started out with a highly leveraged account and with borrowed money, which is definitely not recommended. But I had a strong risk management right from the start. So I never really got myself into big trouble early on. So I was making money, but it was a $25,000 account, which I had leveraged up. And I was more interested in, just nice, steady, consistent profit. So I didn't make a ton of money those first couple of years. But then I, graduated to trading other people's money and then, working for an educational company, creating my own course first, actually, then working for an educational company. So, I've kind of run the gamut of a few different things. But really, my passion is trading and finding those trades via technical analysis.
How has the trading style evolved since you began trading? Has it been always the same kind of strategies and kind of things you're looking for, or has it changed a lot over the years?
Yeah, it's changed somewhat, but really the basic principles are there. And one of the best things I found early on in my career was Stan Weinstein's book, Secret for Profiting in Bull and Bear Markets. And basically it drove into my mind that, you don't buy stocks in downtrends. That has saved me from, kept me in the business. I've seen so many people get blown out or, go have to rebuild and come back buying stocks in downtrends. So that was really the first and foremost thing is I only buy stocks that are in a primary uptrend. I wait for a pullback and then, I've refined it in terms of the timeframes I look at, the time I'm willing to hold a stock, and then tools like the anchored VWAP, which has really become much more critical to me since about 2015 when I convinced TC2000 to add that to their trading platform, to their charting, that is.
That's interesting. It's a really good book that I also remember reading that I really like from Stan Weinstein. So pretty cool you mentioned this. I wonder how many people read that book today, though, because it's pretty dated at this point. And it's definitely good lessons, but people these days seem to kind of forget the old books.
Yeah, there's still a lot of classic principles in there, and it's still a great selling book. My first book, Technical Analysis Using Multiple Timeframes, I kind of expanded on what I learned from Stan and from other places, my experience. and use that for trend alignment, meaning that we've got a stage 2 uptrend on the daily time frame. On the shorter term time frame, if we're stage 3 decline, I'm going to avoid that. I'm stage 4 decline, I'm going to avoid it. Stage 1 on the shorter term time frame, I'm going to start to anticipate where the buyers might take control. And then right at that first part where we're in a short term stage 2 uptrend, that's where I want to participate, because now we're in alignment. The two trends are in alignment. So it's about being patient, obviously, and waiting for the evidence rather than just saying, hey, I'm going to buy a pullback to this moving average or to this VWAP or to Fibonacci or something like that. It's a lot of planning and waiting for the right opportunity, then pulling the trigger and making sure, to manage risk. That's the key.
Does that idea of trading multiple time frame also work well for catching reversals, or is it mostly for trend-based trades?
Yeah, for me, it's trend-based trades. I don't really think it's great for reversals because you've got a stage 2 uptrend that pulls back hard. Let's say and you're looking to buy that bounce. I'm not trying to buy the bounce. I'm waiting to see the smooth transition from sellers to buyers, and then the buyers regain that control. To me, it's just that suits my personality, and that's a real important point for newer traders is understanding where you fit in terms of your personality, your risk profile. So me, I've always been pretty risk averse, and it kind of runs contrary to what most people believe a short-term trader is. They think, oh wow, that's so you must be so stressed out. It's so risky. And I'm like, it's not risky. No, not compared to what you're doing, just buying and holding and watching these stocks decline 50%, then feeling like a hero when they're back up 10%. That's risky. I'm a risk manager. I manage risk first and foremost. So there's very little stress in that.
How did you figure out some of your personality in trading? Was it through trial and error, like trying different things and going back to other stuff? Or did you sort of feel from the start kind of what kind of personality you had?
Well, I mean, I kind of knew that I was a trend trader. Part of when I was working at Lehman Brothers as a broker, I was working for a senior broker there, and he would buy stocks of companies that reported better than expected earnings and had a good chart pattern to go along with them. And I remembered him just doing really well with that for his clients, much better than the other brokers in the office. So that kind of set some of these principles in place. Then I found Weinstein's book, but I've tried mean reversion trades, and I've learned the hard way that I lose money on those net on balance. I tend to get too emotional. I think, well, it's going to hold this 20-day moving average. I'll buy some. Oh, it didn't hold that. It's at the 38.2% retracement. I'll add a little. It's got to hold there. Then it goes down to the 50-day moving average. Well, this is clearly the bottom. I'm going all in, and then it keeps going lower. I end up puking it out and taking a huge loss. So that clearly does not suit my personality. And I don't think it suits most people's personality. It's a way of looking at, hey, maybe I can catch a quick move if I get that reversal right. But, 7 out of 10 times I wasn't getting them right and, experiencing losses. So that's how you learn your styles, through trial and error, I think. And, the key is, to do it with smaller share size until you get to the point where you recognize who you are in the market. One of my favorite phrases is, if you don't know who you are in the market, if you don't know who you are, the market's an expensive place to learn. So, keep it small, keep it light, figure that stuff out. The market will be here. There's no hurry to get involved. So just keep it sane and learn and practice on small sizes to start.
That's a good one for sure. Now, tell me a bit more about VWAP, which is a tool you're using a lot. I know people who would think of VWAP as a moving average and that's it, but how much does it go beyond a simple moving average?
Well, okay, so a simple moving average is just a time and price based. It's, a 10-day moving average says, here's the closing price of the last 10 days, divide it by 10. That's the average of the last 10 days. On day 11, you drop day 1 off, and day 11 becomes the new day 10. So it moves with new data. Similar, the volume weighted average price, it moves. It's a volume weighted average price, meaning that it has a fixed starting point. So the traditional VWAP starts from the beginning of the day, 9:30 a.m. New York time. The market opens. That first trade counts just as much as the trade that occurs at 10:35 a.m. or any other time during the day. So what it's taking is the average price for a fixed unit of time and saying, here's where the true average is based on price, volume, and time. So it adds in the volume. It tells us the true, price memory. Price has memory. So the VWAP is simply for one day. The anchored VWAP is we choose a place other than the beginning of a day. It could be, the noon high that the stock made if you're an intraday trader, or it could be the high that was, or the low from the COVID in 2020, or the high that was made in 2022, anchored off that peak. It tells us, so what it's telling us is when that average builds, it's a cumulative average, but it does move. So it's a cumulative moving average because it builds from that start point and it moves with each new piece of data. So it's a cumulative moving average rather than a simple moving average. And it tells us if we're above that volume weighted average price, the buyers are in control. The short sellers are losing money. That's just a fact. It's a mathematical principle. There's no argument about it. So we can start to see, for instance, from earnings reports. If you think about NVIDIA and the most recent earning report there, if you anchor to the beginning of that gap, what we saw was, a week and a half ago, 2 weeks ago, the stock came down perfectly and touched on that volume weighted average price from the gap. Buyers showed up there and then the stock continued to move. So it's a tool that institutions use for execution of their orders. And it's morphed into a technique to, analyze the data. And it's 100% objective. It's not, some weird math formula. It's telling you here's the actual price action, that's based on the participant, every single participant.
So it's basically used as a place for looking for a bounce in the trend, right?
A lot of times it can be used for a bounce. It can be used as a place to say, for trend reversal. If you're saying it's pulled back down to this volume weighted average price from the low 2 years ago, that to me is a place where a bounce might occur. So I look at it, not as support, but a level of interest, potential support. I look at it, it pulls back, to that VWAP or that anchored VWAP. I'm not going to necessarily buy straight away, just like I wouldn't buy right at a 20-day moving average or a Fibonacci. I'd say that's a level of interest. Now I want to see that if in fact the buyers have, programs to buy in this area because this is so-called fair value, then it's going to show on the shorter term time frame. So it all goes back to that multiple time frame analysis and saying, now we have a level of interest. Let me switch to a shorter term time frame to see if the buyers are in fact gaining control. If the stock just continues to blow through that level, well then, I just watched it. I didn't buy it and lose money, right? I'm not going to blindly buy into any level. I just can't do it. I have to wait to see that it does in fact become support. So if it starts to show, that it's finding support there, and then as it starts to bounce, then I want to buy with those momentum away from that level. And then of course, set my stop underneath that most recent low in case it's wrong and it, pulls back down and reverses lower.
How do you pick the period of your VWAP? Is it based on like how the market moves in different conditions, or is it based on the period you want to trade it in, or how does that kind of work out?
So great question. It's all time frame dependent. And if you're simply a day trader and you're in and out of one stock, 15 times a day, well, you have your daily VWAP that begins at the beginning of the day. Let's say the stock gaps up, pulls back down for the first 8 minutes, then it gets back above the daily VWAP, then I want to buy there. It shows the buyers have regained control after some initial profit taking. Let's say it runs up for an hour and a half, up to 11 a.m. and then it starts to pull back. So at 11:10, I see, that was an important high at 11 a.m. I'm going to anchor from that peak. And then I want to see that, as the stock pulls back, maybe it finds buyers at the daily VWAP and then it compresses, underneath the volume weighted average price anchored to that 11 a.m. high. And then as it gets back above there, it tells me now from the highest point paid this morning, the buyers are back in control. I want to be a buyer here if I have a low risk place for my stop. That's on a daily chart. Same principles apply on a 1 day chart. Same principles apply whether you're looking at a 15-minute chart of the last 20 days, a 30-minute chart of the last 40 days, or a daily chart, or whatever the time frame is. All of those same principles apply because of the fractal nature of technical analysis.
And have you seen VWAP work in like a bunch of different instruments, or is it mostly working for stocks, or is it like different across different instruments, the reliability of VWAP?
So I look at it for individual stocks. I look at it for ETFs, futures as well. I'm not a Forex trader, but everyone has told me who uses Forex that they find value in it. It works great in some of the cryptos. I've traded Bitcoin successfully and Ethereum with it. Solana, some of the other ones. But, as long as you have price, volume, and time, then you can access this tool. And again, it's just 100% objective. It's not like, well, it's oversold or it's overbought. That doesn't really mean anything, right? That's subjective. What it's telling us is here we are at that average price. This is a level that's been important to the market. If it's important again, the buyers will show up here, and then the sellers will start to realize, hey, there's buyers here, so I'm going to stop selling. And the buyers get a little bit more aggressive and start buying the offers, and then momentum begins from there. So it's just a fascinating tool to really look at. And first, you have to understand that market structure and how money flows in a cyclical way, through the market on all time frames.
One thing I want to get your thoughts on is you've been coaching traders from SMB Capital, which I believe are not really new traders, or probably more experienced than like the newbies in the market.
Right.
What are some things these traders struggle with at SMB? What are some things that they have to work on?
I think the same things that everyone does. So, there's all kinds of traders at SMB. SMB has guys that have been there, 10, 15, 20 years who are extremely successful, but they're always bringing in new guys who are, trying to learn right from the start. And the great news for them is they're learning from a structured environment. So, someone at home might just say, hey, I'm going to start trading. I'm going to read a couple books, watch a few videos, and just kind of do what I want to do. Instead, they've got, teamwork, and they work on those together. They break into little pods, and they say, here's your group. Let's work together. Let's analyze these stocks. So it's more that you've got, extra sets of eyes. They struggle with the same things, though, buying when the stock's up too much, thinking the stock is down too much, trying to catch a bounce, and that sort of thing. It's all the same things for everyone. I mean, you go look at the biggest hedge funds on the planet. They're not immune to the same mistakes you and I make.
Are they more using a discretionary kind of approach, or is it more systematic, or is it kind of depending on each person?
But each person, I mean, some of them are super, into their, their playbook, as Bella's book, you make your play, your one good trade, make your playbook and know what your plays are. But I think that, similar to mine, I consider myself a discretionary tool, but I have a lot of guidelines. I don't necessarily have rules that I have to do this every single time something does that, but it's more, okay, now we're in this area. Now I'm going to use my mind to think about what's the overall picture in the market. Does that support this? How's this sector acting? And just the little nuances that you get from, having a lot of experience in the market. So there's, rules based, but not always 100% adhered to. More guidelines is what I like to call it.
What do you think makes a good trading coach? Because it's one thing to be a good trader, but then it would be a different thing to be able to coach someone well. What do you think makes a good trading coach overall?
I teach people every single day. And in that teaching, I think that the teacher has to, what I struggle with is putting myself back in the position of that newer trader. I sometimes, forget that, what's intuitive to me is the result of decades of experience. But what I find most effective is, just kind of tough love. Don't be a prick, but let people realize, wait a minute. Why would you want to buy that stock? It's up 20% in the last 3 days. Where does your stop go? What do you think can actually happen here? Just to hold them accountable and to recognize potential mistakes, let them make those mistakes themselves, but tell them in advance, here's why I think it might be a little bit riskier, or I might trade less share size. But these are lessons you have to make the mistakes yourself. Otherwise, if you don't make the mistakes yourself, you're never going to really learn anything. So someone who is, positive, encouraging, but is willing to say, wait a minute, slow down there, take a second look at that, and to give them the seeds to figure it out rather than just telling them what to do.
That's a good point. I think a lot of traders are looking for answers from a coach or a mentor, like someone to give them exactly what to do. While that can be good sometimes, but other times it's not the way you really learn and become better. So you make a good point here.
Yeah, I always encourage people, I'll share an idea and I'll say, I like this stock if it gets above here, and I would probably put a stop here to start out. And if people follow that directly, I kind of look at them and say, think for yourself a little bit here as well. Improve that. Make it your own. That's what I always like to say is make the trade your own. I might talk about 5 different stocks. One's $380, one's $4. And some people might not like $4 stocks. Well, then don't trade it just because I spoke about it. Find the ones that are suitable to you. If you don't like to trade airline stocks because they're commodity related or you're afraid of a terrorist event, then don't trade them. Don't feel left out if you miss an opportunity. Missed opportunity is better than lost money when it comes into these trades. That no one's going to catch all the winning trades. You've got to be willing to let some of them go without you, and don't beat yourself up for missing them. It's make it your trade on your time frame, and recognize just that you're not going to catch them all.
I think one of the other next kind of mistake here is trying to overcomplicate things a little bit too much. Some people might read a book, or they might like watch videos from you, and then they want to use your VWAP. They want to use something with like combine with other stuff from other people. How do you avoid to make this too complicated with trading?
Yeah, that's a great point. For me, it comes down to, when people look at my charts, they say, well, what do you look at? And I said, price, volume, and time. Those are the 3 most important. So only price pays. Volume tells us the emotional intensity, commitment. Time is subjective, but it comes down to those 3 things. So, the only thing on my charts is those plus some simple moving averages and anchored VWAPs. I've looked at all the other pieces, the stochastics, RSI, Adams Pitchfork, sunspots, you name it. And I, always be curious and willing to learn, but keep it simple. There's a phrase, I forgot who said it, but, simplicity is the market's greatest disguise. That, it's just like losing weight. How do you do it? Well, you're more active and you eat less. But, people can still, sell billions of dollars worth of this new program to help you with it. Each year, there's a new fad diet that is willing to be sold because people want shortcuts. And the shortcuts aren't, how you do it. You do it by keeping things simple and focusing on what matters. The thing that matters most is price. That's why I always say only price pays. Because at the end of the day, you can come up with 100 reasons why you thought the stock was a good buy. If the market doesn't agree, then your opinion just does not matter.
Yeah, good point. Same thing goes with trading. So there's always going to be a new method people want to talk about and prefer, and people might be tempted to go from the old method to the new method just because it's apparently better. But being able to stick to what you already know and are good at it, definitely a big key there.
Yeah, it's it's difficult because there's so much information available, and there's so many people passing themselves off as experts. And there's some great young people out there who've done a lot of good learning about the market, and they have 2 to 3 years of experience. And I see them getting, hundreds of thousands of people following them on Twitter. And I look at it and say, these people are book smart about this, and that's a great start. But you need some trading experience and to really get in there and understand the nuances of what's going on in the market. So to me, it's, it takes time. It's about finding your personality again in the market, your time frame. What, I'm most comfortable with the shorter term time frame. I call my shorter term time frame, anywhere from a couple days to a couple weeks, ideally. That's where I am at my stage in life. My real active day trading days are behind me. It doesn't mean I don't do some once in a while, because I still have that skill set, but it's just not in my personality anymore to really be interested in sitting down and battling it out every day for 20 cents here, 30 cents there.
How do you keep improving or developing as a trader? Because there's always that balance of like doing what works and trying to also learn and develop and kind of apply new things. How do you kind of keep that balance?
Yeah, that's a difficult one because, especially if you're trading, on your own, that, you don't have someone there pushing you. So you sounds like you speak highly of SMB, and I think very highly of them as well. They, help recognize a talent, and they'll push you, buy more, get involved, go heavier. You're there, have confidence in your trade and that sort of thing. It's easy to become complacent in where you are, just doing it by yourself. So I think everyone should, could benefit from a performance coach or someone outside of yourself to say, to look objectively at some of the blind spots that you might see to yourself and say, hey, well, why did you get involved in that trade? And it doesn't even have to be someone who has a lot of trading experience, just someone who's a good performance coach. It could be, someone who's, been trading athletes and that sort of thing, but has a good mind for performance and breaking through to new levels. That's, outside resources are the best way to do that.
Yeah, and also just connecting with other traders sometimes help, like having a group of buddies or traders you can talk to just to kind of see what they're doing differently. Also a good key there to help.
Absolutely, 100%.
What would be your advice for people who are new to trading? They're trying to kind of find out what they want to trade or what they want to use. Should they kind of learn a strategy and just stick to it, or should they kind of try to make something of their own first?
I think they need to, find a strategy that makes sense to them. And if it helps them make money, refine it to their personality and their time frame, and have one or two bread and butter type of, strategies that that you perform well at and can kind of consistently go back to, but always be trying to, try new things. But when you try new things, look at them with, much smaller share size and recognize you're outside of your normal, you're outside your wheelhouse, as they say, and that, it's time to go slower here and recognize there's greater risk because you're in uncharted territory. This is new to you. So go slow. Don't be in a hurry.
What would be a process for trying something new? Would it be to kind of test it first and make sure you have some past data to look at it? Or would you just sort of go live and just trade on small size to look at how it perform live?
I think you have to go with live, small share size. You've got to feel the emotion in there. And if you're not feeling the emotion, then it just isn't real. The losses, you can justify all you want. You can, ignore them and just focus on your winners. You have to have some money, some skin in the game.
Anything we didn't kind of touch on or talk about you want to mention or you want to focus on? Any advice you think traders should kind of have before they leave this interview?
Well, I think that we've, kind of covered a lot of that. It's about finding your way in the market, going slow, getting the education that makes sense. Consider the source of where you're getting your information from. Is it somebody who's just read a lot of books and is basically writing a book report? Or are they people who've, been involved in the market and coming up with new things and learning with their own money? That to me is what separates, what the good advice is and what the bad advice might be.
Something else you gotta tell me about is expectations. A lot of people are probably coming to you with big expectations, some may be more realistic. How do you kind of help to readjust these expectations of people when they come in the market?
Well, you have to remind them that, listen, this is a tough game that, 80+% of money managers fail to beat the S&P 500 each year. And people are saying, hey, I've got a $10,000 account. I want to make $100,000 this year. Okay, so you're going to make a 900% return when, the majority of professionals that you're competing against aren't able to beat, 15, 18% a year. How realistic do you think that really is? Now, you're a brand new trader and love your enthusiasm, but yeah, you've got to be realistic. There's just, people want to quit their job and they've got a $30,000 account. Well, if you do 20% a year, that's a pretty good number. If you do that consistently, that means your $30,000 account, you're going to make $6,000 this year. And, you've still got a $30,000 account because you took that $6,000 out to pay for your little 1-bedroom, 200 square foot place that you're barely surviving and eating mac and cheese on $6,000 a year. Keep it, you need a lot of people come in underfunded and thinking that, they're going to be the next great trader. And they might have one or two big trades that they get involved in where they maybe get lucky or maybe they were good and they leverage up and buy a bunch of options. They turn that $30,000 account into $100,000. They think they're on top of the world. And then what happens? Well, over the next 6 months, they take a $3,000 loss, an $8,000 loss, $2,000 gain, but slow trickle down to, back to that $30,000 level. And then they start gambling real hard, and then they end up losing the money. It's, these are things that other people have gone through and have experienced, and there's nothing new about it. You're not going to be the best trader there was. That's just the way it goes. There's, it's the same thing as everywhere. I wouldn't discourage people from trying. I'm not trying to be a downer about it, but again, you asked me what makes a good coach is keeping things realistic. Saying, listen, I would love for you to be the guy who can turn $30,000 into 100,000, and next year 100 into 500, and then 1 million and 5 million. But the odds are simply against you. It's just not realistic. You might think you have it, but keep it realistic. That's all.
I think people to check out your books. I think you've got 2 really good books out there. So Maximum Trading Gains with Encore VWAP, the most recent one. And you mentioned Technoanalysis using multiple time frame, also the previous book you wrote, which are really good books for sure. Where else can people connect with you or find out more about you, about what you do after this interview?
Yeah, I mean, the best place is Twitter. I'm, at Alpha Trends. I've got a large following there. Any free information I put out, I always put it on Twitter. But I do have a weekly YouTube video, so you can subscribe to, Alpha Trends on YouTube if you don't want to do Twitter. And then alphatrends.net, I've got a subscription product and that sort of thing. So it's heavily education focused. And, those are the 3 places.
Any advice you have for traders before we leave this interview or we finish off? Anything you want to let them kind of think about or let them go with?
Well, yeah, I mean, just, again, be realistic, keep your ego out of it, and, find your process, find your personality and what makes sense to you in your time frame. Those are the most important things. And then try to be able to tune out the noise. Just because Warren Buffett is buying Occidental Petroleum and you're a swing trader, you don't have to care. You really don't have to care about what most of the news tells you you're supposed to be interested in.
Good point. I appreciate it. Thank you, Brian, for your time and for the advice you gave to my listeners here. I think this has been of great value. I hope they connect with you and see what you're doing out there. You do some good stuff. So I really appreciate the time you spent with the interview here.
Great. Well, thanks for having me on, and good luck to everyone out there.